Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and we have a real treat for you today. One of the people that I really follow a lot, Mike Green. Mike is one of the people that I look for information. I think he's as well read, as much knowledge as anybody that I ever see. Mike's the chief strategist and portfolio manager really at Simplify, which has tons of products. You'll see their website on the call here below. And Mike's been around. He's been in a lot of different places. I'm not going to go through all of them. But Mike, one of the things we like about you is you manage money, and you're not just one of these people talking it, but you're walking it at the same time. But we're glad to have you.
Oh, well, that's really kind of you to say. I appreciate it very much. Yeah. It's a pleasure to be here.
Yeah. We're just going to hit a few topics, Mike, but one of the topics that's always up front is this idea of inflation and where that's headed, or where people think it's headed, and everybody's got a view on it, but how do you see it?
Well, so I think this is obviously one of the most important challenges that we have right now. You have a chart that you had shared with me that looks at inflation and the fact that it's peaked in both PPI and CPI and appears to be coming down. Now we've had that interrupted at the start of the year with some pretty strong inflation prints. And the thing that I'm paying the most attention to in the inflation story is how we have chosen to repeat the patterns of the 1970s in terms of how we chose to deal with this inflation, instead of the patterns that I think are actually probably more appropriate, the inflations that arose after World War I and the inflation that arose after World War II. In both of those situations, we did something very similar to what we did this time around. We shut the world down. We cut down, all the transmission of consumer products and basically created conditions under which households had excess savings that they'd accumulated that they couldn't spend. And lo and behold, when we open the economies back up, when we bring the soldiers back home, when we try to move from building tanks to building automobiles, we discover that shortages emerge and prices rise sharply, right? That by and large describes what we've seen in the inflationary front. Now, the way we handled this post-World War I and the way we handled this post-World War II is not to hike interest rates, but instead to create incentives for increased production and to encourage investment under that framework. In the aftermath of World War II, we saw inflation of nearly 19%, so quite a bit higher than we saw this cycle. And yet that was gone within 18 months because we chose to encourage increases in supply as compared to damping down demand, right? Demand is really hard to kill. And there's very clear economic evidence behind this. I believe the economist is Robert Hall, who wrote on this in the 1980s in the aftermath of the 1970s inflation. What most people have very clearly identified is that what's what you would call the coefficient of response, right? So how supply or demand responds to increases in interest rates. Demand falls much less quickly than supply does, right? Every CFO out there that you're probably talking to is telling you, well, it's clear the Fed is trying to engineer a recession. Therefore, we don't want to build up our inventory levels, right? So we're going to restrict production. We're going to try to keep prices high. We're going to try to be very cautious, et cetera. That's exactly what we're seeing. That's being magnified by the dynamics of horizontal acquisitions, the consolidations that we've seen across industries. So there's much more market power that's coming from individual participants. Candidly, I look at the behavior that we're engaged in and just think this is, I think the technical term is a little crazy, right? The idea that we should just try to shut down the economy again in order to get inflation under control strikes me as really poor planning.
And, it seems, though, Mike, that we're really not doing anything on the incentives on the supply side.
No, if anything, we're doing the opposite, right? I mean, that's part of what hiking interest rates is it's increasing the cost of capital, increasing the costs associated with carrying inventory, planning new facility production, et cetera. This is, in my opinion, we're experiencing one of the biggest policy mistakes of our lifetimes, and it's very painful for me to watch this. Now, I'm extremely heterodox on this, right? So I don't follow the traditional views on this, but there is an expansive body of literature that suggests that what we're doing right now is perversely stimulus into the economy that many of your clients, right, who have assets, suddenly they're discovering, guess what? I can get a CD or I can get a money market fund that pays me real money on the balances I was carrying anyway. Right? It's not like they stopped carrying those balances because they had 0% interest rates. They kept that cash for optionality, and now all of a sudden they're getting paid on it. What a fantastic, stimulus.
I was telling somebody yesterday that look, if you look at the 1-year Treasury and the yield on the and the earnings yield on the S&P, they're almost dead even.
Yeah.
Like, why would that's what happened in '87? Why would you do that?
And by the way, that's the earnings yield, right? So that's before you start thinking about the dividend yield, which is really your cash return. Some people would argue you should include things like buybacks, et cetera, but buybacks are going to falter in the face of much higher interest rates.
Yeah.
We're already seeing evidence of that as well.
Yeah, and I'm not certain that's not a good thing in the long run.
Yeah,
but anyway, maybe I'm in a different camp on that. But let me ask you, okay, so with inflation where it is, and then we're going to shift over to what they're doing on the rates. If we go to graph here on the 3-month and the 10-year, sort of what's going on there. And it's been a big move. I mean, it's been a big move in this last 12 months. You can see it on the graphs.
Yeah. This is the biggest move we've ever seen. It's just there's a degree of expressed confidence in rate choices that certainly, as I indicated, befuddles me. Right? I don't quite understand why we're doing what we're doing.
So would you expect, Mike, that to go ahead and roll into a deeper recession because of that?
Well, I think there's two separate sides to that, but yes, ultimately, I do think that we'll end up having an event, is I guess the way I would describe it, and we broadly see this in the corporate debt sector, where issuance is extraordinarily low. It's not dissimilar to the mortgage market, right? So we see similar dynamics. Basically, we have suspended credit issuance across the economy as everybody is desperately hoping that they can wait to refinance until the Fed starts cutting rates, right? We're seeing corporations that are being forced to go into the market to tap financing at this point. They're being forced into much shorter dated paper. So we're seeing a lot of 2-year issue, for example. Our mutual friend Danielle DiMartino Booth has done a great job of highlighting the shape of the corporate credit curve, the fact that 2-year paper is in some cases yielding more than 10-year paper. Why would you take on additional credit risk in the corporate sector? It's not the same thing as the US government bond, right? There's no credit risk difference between a 10-year government bond and a 2-year government bond. There may be some inflation risk and some other components to it, but there's no credit risk. In the case of a corporate, like, you have to be kind of an idiot to decide to lend to somebody at 10 years at the same rate or lower than you would lend to them at 2 years, right? So it improves your position in the capital stack and everything else. Unfortunately, that just exacerbates the dynamics of a refinancing wall that we're facing into 24, 25.
It's interesting too. We get offerings all the time on a lot of 2-year and 3-year paper, and the spread on treasuries, Mike, is not very big. It's pretty tight. So why would you, we tell the dealers all the time, hey, we wouldn't go that direction because you don't pay us to do it. I mean, we stay with the Treasury.
I think it's really hard to justify taking the additional risk and going into unprotected forms of credit as distinct from interest rates, right? I mean, this. Most of your clients are at a stage in their lives, and this is true for all managers, by the way, because by definition, those who have money are old, right? So we're getting to the point that nobody actually needs to make more than the 4 to 5, 6% off of the asset base that they already have. If they can get that almost risk-free, that's like the giant hallelujah sign, right? And we're seeing this in corporations that are defeasing their pension plans. We're seeing this in risk-off behavior as individuals increasingly replace stocks within their portfolios, et cetera. But that process is just starting. I mean, the investment committees are just now sitting down to say, why are we taking these risks to get what we can, basically get guaranteed in cash instruments now?
Yeah, it's there is something besides Tina. I always call it Tia. There is an alternative now. And so
you're the second person to say that in 2 days to me, by the way. That's pretty funny.
Well, I may have coined it because I used it 2 months ago in a speech, so I could have been the original coin. I've never originally coined anything. But that would be, unlike you, I don't have all this information in print sometimes. But so as that, looking into that, okay, and where we are in the stock market, if you look, there's a graph here on the NASDAQ and the S&P. And I know everybody got excited, and you remember, and I remember 2001 when you also had that move in January into first week or so of February, and it was a pure fake out. But do you see Do you see that it looks maybe like that, or how do you see that with the stocks from this point forward?
So I actually think the parallels are a little bit later than that. So in a weird way, I would describe what we experienced in the fourth quarter of last year is very similar to the behavior we saw in the aftermath of the 9/11 events, right? And if you remember what happened then, governments around the world, particularly the United States, began to flood the system with liquidity. In this case, it wasn't the Fed, and I've made this point elsewhere, and I could pull up a chart in a second to show this, but it wasn't the Fed that drove liquidity. In this case, it was the Bank of Japan, the Bank of England, and others who were responding to events that occurred within their local currencies that began to print furiously, right? Bank of China, for example, began to as well. We've seen those dynamics play through in basically a risk on event that is not dissimilar because of the provision of liquidity to what we saw in the aftermath of 9/11. And then if you remember, what happened is you had this moment of kind of levitation where everyone's like, seems like things should be much worse than they are. Are they really much, the early parts of 2002? And then we found the credit events, right? We found WorldCom, we found Enron, we found all these things that just began blowing up in our faces. And that really was the real event. As you know, I was a small cap value manager over that time period. They didn't start to go down until the spring of 2002.
Too, what happened, it sucked a lot of people in by March and April of '02. I know you remember this. The markets had perked up enough to where you had a lot of people that had stayed pretty bearish for a couple of years, actually, and they thought now's the time. And then they took them all the way down into October of '02. And it was just like you say, that's when the damage came.
Yeah.
So you similar now. You think similar to where we are?
Unfortunately, I do think it's a little similar this time around. And we're seeing that, right? So I know you do some work in real estate, for example. We are very much seeing that dynamic play through in the real estate sector, where every single day now we're coming in and finding a commercial lender who is walking, or commercial borrower who's walking away from a mortgage property. Right now, it's a little bit of a game of chicken that's underway right now. They're effectively all trying to renegotiate by defaulting and basically saying, "Hey, work with us." It's kind of falls into the classic adage of, if you owe the bank $1 million, that's your problem. If you owe the bank $1 billion, that's the bank's problem. All right. So when you have $1.7 billion worth of property that you suddenly flip around and say, "Hey, we're looking at this. We don't think we can really pay this bill. Do you guys want to take this over?" Right. And the reality is, and again, this is what we saw in 2008 that people probably remember. Banks don't want to operate real estate. They don't have the skill set. They don't know how to do it. Right. And so their objective is to get that off their books as quickly as possible. What I would argue is largely happening right now is just that most participants are trying to scare the bank into returning it back to them under a renegotiated loan structure.
And we've seen a number of those just the last 2 weeks.
Absolutely. No, I mean, literally every single day we're walking in and they're getting bigger and bigger and bigger. Today or yesterday, late in the afternoon, we heard of a PIMCO-controlled entity with $1.7 billion. A couple of days before that, we heard about Brookfield in Los Angeles.
Like Brookfield was almost $1 billion, wasn't it? Or just under it? It was a lot of money.
PIMCO was 1.7, I believe.
Mm-hmm.
So, you drop $1 billion here, $1 billion there, pretty soon it adds up to real money, right?
The other side about the real estate thing is, at least I find this true in different cities, the people in the industry are not sober yet. Now, maybe you don't see it that way, but like what I find is they're like, it's just it's a little dip here. We got nicked a little bit, but we'll be right back. It doesn't seem that way, but that's what I think they think.
Yeah, it's a legitimately hard one right now because we have been trained to think that the Fed is going to step in and stop events from occurring. In this situation, I just think we don't really know yet, right? We just really don't know. And it is very clear that the Fed doesn't want to have to cut interest rates, doesn't want to respond to this. If you remember, the last time we had that dynamic where basically serious appointed representatives, not elected, let's just be clear on that, but appointed representatives of the U.S. government made the decision not to endorse moral hazard. We called that event Lehman Brothers, right? So there's a game of chicken that's underway, and maybe the Fed wins. I think the problem that I'm struggling with is I think it's ultimately a Pyrrhic victory under current construction. And so I wanted to show you a chart just very quickly. So this is looking at something that I was referring to as you and I were talking offline, right? The most important thing to remember about price behavior is in any form of good or commodity, you can stack up the change in price versus the levels of inventory. This is looking at the levels of auto inventory, and it's actually adjusted for population. So this data goes all the way back to 1990. It's looking at the relationship between the inventory and the changes in price. And what you're experiencing right now, what we experienced particularly at the peak, is effectively massive inventory shortages, right? So dealers were able to say, wait a second, we don't have any cars available. If you want a car, if you're moving out of the city, you go to the suburbs, or you need a new car because you now live in this suburban existence that you didn't before, we can charge whatever we want for it. And that's really what we're seeing is this incredible growth of market power that's basically tied to inventory shortages. Part of my frustration with this is that we're not seeing adequate moves to address these issues on inventory. We're basically turning around and saying, well, there's really nothing we can do about it. And we're trying to hike interest rates, which is theoretically supposed to put pressure on demand, but is actually exacerbating these conditions, right? I mean, just take the extreme version of it. Who's going to start up a competitor importing autos from China, for example, to address shortages in this type of environment where the cost of capital is really high? Nobody, right? I mean, the barriers to entry are high, the challenges associated with trade are very difficult, et cetera. But that's the sort of thing that I'm watching very carefully because I'm just not seeing us propose any solutions that are legitimate about addressing these shortages, right? Unlike what we did in prior cycles. And by the way, exactly what we did in the 1970s when we tried everything other than saying, hey, how about we make more stuff, right? The 1970s was all about let's have cleaner air, let's reduce environmental pollutions, let's put additional restrictions on expanding production, let's limit all sorts of behaviors, let's put price caps on things, let's hike interest rates. We're making all those stupid choices again, and I can't figure out why, but we are.
So let me ask you, to switch to something, and I know you know a lot about this because so many of the funds and different things you do look at leverage. But I'll start with margin debt, which the markets usually follow margin debt. But if you want to move that further, even into real estate, securities-based lending, everything, it seems as though we're just starting to deleverage. How do you see that?
I think that's right. And again, I think that it's this underlying dynamic of playing a game of chicken, right? I mean, when we talk about delevering, there's two ways you can delever. You can raise incomes and you can pay down debt, right? That's challenging, but feasible in many situations, tends to lead to a period of very slow growth, et cetera. Or you can get rid of the debt quickly and easily under a settlement system we call the U.S. bankruptcy court, right? And that appears to be the path that we're now heading. That's, again, what's happening in the commercial real estate space. That's basically a violent restructuring of debts that occurs with the support of the government, right? The justice system. We have tried to avoid that as long as possible. And I should actually share a chart that another friend of mine sent me. So what you're looking at here is a chart of net charge-offs, right, versus charge-offs from C&I loans that are being reported relative to the proportion of senior loan officers that are tightening credit, right? Now, one of the things, right, all from banks. This is all from banks. And so this is a shortcoming of this analysis, right? They tend to be extremely positively correlated. But what you're actually looking at here is a feedback loop. So if you just think about it, if your banker is very willing to extend you credit, you're probably not going to default, right? You're probably not going to have a charge off unless something really, really catastrophic happens that is idiosyncratic to you, right? You're struck by a bus, you can't pay back your bills, you go bankrupt. It has nothing to do with the economy. But if the bank is actually tightening up credit conditions and you go in and you say, hey, I'd really like to pay off this loan that's maturing with another loan, right? Use the proceeds from that second loan. They say, yeah, we're really tightening up credit standards. And candidly, we're not as sure we're going to get paid back on that second loan at the much higher interest rates that exist today. Well, then guess what? You're going to start to default driven by a credit cycle. That's really what appears to be underway right now. And so we're seeing record low charge-offs. In other words, the P&L has been overstated for banks in the history, right? The data that we're getting. at the same time that we're watching them tighten up credit conditions, it inevitably leads to that tightness and that increase in the charge-offs. So bank earnings are going to deteriorate as we go forward on this type of stuff. It's the cycle. We've been through these over and over again. It's very clear in the charts. And I know, Ted, you know it better than most. But this is the sort of stuff that we're looking at over and over and over again. It's just we're not there yet.
I'll tell you the reason why I'm involved in a really great bank that I have. It's just one of them, a very conservative bank. And one of the things I notice about all the banks right now is it hasn't caught up. In other words, they're really excited because their spreads widened and they made a lot of money, the last 14 months because the spreads widening. But I always say the second shoe to drop on that is when people start showing up and say, "Hey, I need some help."
Yep, absolutely correct. And that is the cycle that has started. Is there an immaculate landing out there? Possibly. I give it very low odds at this point, but we're certainly entertaining that as a thought process right now. The other thing I would just highlight for people is remember that things like expectations. So one of the things people will point to is they'll say, we're getting a strong run of macro data, right? Data is coming in better than expectations. Well, that happens going into every recession because people immediately hear recession. They're like, oh, it's going to be the end of the world, right? And instantaneously it's all over with. Everybody's going to lose their job except for me, hopefully, right? Because when you lose your own job, then it's a depression. But that's very much where we seem to be, is in this dynamic of kind of the waiting game for this to show up. What we don't know is how fragile the underlying system actually is, right? And that's where I think some really interesting stuff starts to play through. And we look at those fragilities, and they exist in everything ranging from the high level of credit and investment extended to the private sector, where we don't get any form of signals back, where there's an extreme divergence between the interests of the debt issuer and those of the debt holders. This would be the first credit cycle that we go into where you have a sizable participation from passive strategies that simply buy in proportion to indices without any real evaluation of the underlying credit or its superiority within the capital stack. And I think all of those are great unknowns.
It's interesting you say that, because I was never going to let you out of this interview without asking you about, I don't know anybody that's written more or knows more about passive and active investing than you do. You've written more about it than anybody I've written. I've read a lot of the things you have out there, but we're active investors. We buy single stock, single bonds, and we felt all along that something would change that's been going on the last 12 years or so, that there's a change coming. But how do you see it?
Yeah. So I think that there's a couple of things. One is most active managers have historically focused on this idea of, eventually our performance is going to catch up, right? Eventually we're going to outperform the indices, and then you'll be sorry that you went for passive indexing, right? That tended to be kind of the rallying cry that people had for years, and then it moved into the, and you hear a lot of this today, passive investors don't know how to vote on stuff, and, they're consolidating control, and that's leading to bad management, et cetera. And all of these things have elements of truth to them. But what most people never thought to really challenge was this idea that you could be a passive investor at all. And I was really fortunate to, in 2016, read a brilliant paper by a guy at AQR named Lasse Peterson called Sharpening the Arithmetic of Management. And this refers back to the paper from 1991 by Bill Sharp of the Sharpe ratio, which most people have heard of. He also was instrumental in the creation of the CAPM formula and all sorts of stuff that we think about and use on day-to-day basis without really challenging it anymore. So Bill's paper in 1991 established the rationale behind passive investment. All active managers, by definition, define the market. So if you simply make a market, then you're getting the collective wisdom of all the active managers. And therefore, it just boils down to fees on average. If you charge less, you're going to outperform, right? this was the rallying cry for the Bogleheads. This has been increasingly implemented in terms of regulatory structure in the United States. Anyone who's listening to this who runs a business that offers a 401k is going to be very familiar with things like qualified default investment alternatives and the role that they play in the 401ks and the inevitability of moving to something like a Vanguard index or target date fund simply to protect your business from liability, right? Like these are all things that are very well established. But when nobody thought to challenge, because candidly the math capability wasn't really there, is the underlying theory that existed in Bill's framework, which is Bill's definition of a passive manager is someone who never transacts. Well, now wait a second. How do you get into the market then? Well, I mean, it must be magic, right? How do you get out of the market? Well, it's got to be magic too, right? Because I don't know of any way you can get into a market or out of a market without transacting, which means by definition, you're not passive. Now, Lasse Peterson figured this out, challenged that part, said, hey, wait a second, this is an inconsistency between practice and reality. And he then highlighted that during periods of index rebalancing, that the indexers were forced to rebalance on those events, that would be an opportunity for active managers to outperform. Now, I will tell you candidly that when you look at firms like Millennium or others that are extremely large and very good at the high frequency stuff, their largest businesses are actually in that index arb framework, right? So they've figured this out. They're arbitraging it. On an event like Tesla's inclusion in the S&P 500, my understanding is that Millennium made like $3 billion on that transaction, right? That's a good day at the office. Yeah, it's literally a definition of a good day at the office. But what I recognized that allowed me to extend Lasse's work was, wait a second, it's not just index rebalancing. Because these entities receive flows from investors every single day, they're always transacting. And so suddenly, instead of saying, are they impacting the market, it became very clear that they were impacting the market. And a lot of my work and your listeners, if they're interested in this, can find any number of videos that I've put online discussing these sorts of things. As you said, I'm probably got the biggest blabbermouth on the planet as it relates to this stuff. But what you have is very clear evidence that the behavior of all this money flowing into passive strategies is empirically affecting markets, right? Where I was first able to exploit this was around what was called the XIV, right? The inverse VIX. This was a smaller market than, say, the S&P 500 or the total market indices, where passive strategies had risen to about 70% of the market on a daily basis. And so this was a market that was 100% dominated by these types of dynamics. And there we saw exactly what I had predicted, which is when a liquidity event emerged, the product went to zero in a single day.
If you look at individuals and a lot of portfolio managers without tons of experience, I don't think they really always understand the passive strategies. It's been interesting to me to this idea you brought up some time back about the float as opposed to market cap, that kind of thing. Well, if you don't do a lot of passive, you probably don't know that and look at those things. But it's I'm going to move that into this next question, which is you have a group now over the last 12 to 14 years that's all they know. They know low interest rates, they know indexing, they know passive. That's it. And so that has to change up something over the next 10 years.
Well, what it does is, and this is the other unfortunate realization of my work, right, is if you have this type of impact, perversely, it actually creates the conditions that are identical to what happened to the XIV, which is stocks go up because of the continual inflows, right? The easiest way to think about passive investing, since we now know it's not actually passive, since it's transacting, is instead it's an algorithm that operates off of the world's simplest rule. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell, right? How much should I buy? Well, just buy it in proportion to whatever the last price determined its market cap or its float adjusted market cap, right? Is that tied to the liquidity of the security? No, it's not, right? And so in fact, what we see is in many situations, while you would expect smaller stocks to be more affected by this. And that is true at the very small end. And at the early index inclusion, you have these huge effects. I could show you some examples that you just be like, oh my God, that's unreal. Um, and by the way, like the SPAC dynamics of 2020 and 2021 very much fit into this criteria, where there were rules around index inclusion that allowed them to get into the indices before the insiders could start selling. If there's buyers and no sellers, guess what happens to price? It goes up a lot, right? Um, so when you have those very very simple rules, if you give me cash, then buy. If you ask for cash, then sell. Then the whole thing actually becomes pretty straightforward, right? It's like, oh, all right, I'm looking for the perturbations that are created by this as compared to anything else. But the weird part is, if you're not looking for it, right? When I introduced these theories, I shared with people the speech by David Foster Wallace, "This is water," right? And that joke of, two young fish are swimming along, an old fish passes them and says, "Hey boys, how's the water?" Kind of look at them strange, swim a little bit further. One of them turns to the other and goes, "What's water?" Right? Um, we're not attuned to think about the medium in which we behave as changing.
I agree. So let me ask you, and I won't spend a lot of time on this, but I did want to ask you a question, and I want if you look at there's a site called Coin Market Cap, and I know you know it. It has all of the coins, and has some of the exchanges, but there's 8,900 of them. Okay, and I followed it from 10,000 on down. I'm throw up this graph here because I want to ask you this question, and I'm not here to knock any of these, and I'm sure Bitcoin and Ethereum, some of those are going to really survive and probably do okay. I don't know, but here's my question to you: where do you think people have been misguided? If you take all of those coins, okay, that they really think there's some utility to it, when in fact, at least to us, there's really nothing to it. How do you see that?
Well, unfortunately, I think this is a byproduct of the same dynamic that I was just talking about with passive, right? Because we presume under an efficient market hypothesis type framework that if there's a market cap behind these things, that they have value, right? I mean, there's a phenomenal interview of now, defrocked Sam Bankman-Fried, who was the high priest of crypto, with Matt Levine and Joe Weisenthal on Bloomberg. This is widely distributed, but it's still phenomenal to listen to. And to listen to the naivete in his discussion, or what I would maybe describe not even as naivete, but venality, as he describes the idea of, all right, let's create a box, right? And we're going to pretend the box has value. And if enough people believe the box has value, then the box has value, right? So that unfortunately is what's largely happened within crypto. It goes back to this inelastic type dynamic, right? And just the easiest example is, I see that you have two lamps behind you on your desk, right? If I were to show up and say, hey Ted, what's the market cap of those two lamps? You'd say, well, it's probably like $200. And you're like, now, you know what? I'm going to bid you $500 million for one of those lamps. All right. Now what's the market cap of those lamps? Oh my God, it's $1 billion market cap lamp, right? Like, kind of silly. We know it's not actually true. We know that if you couldn't find somebody who was quite as dumb as I am to do that, that you couldn't create that. But when you have an unregulated market like crypto, it's very easy to engage in things like wash sales, in related party transactions without people knowing, and create the illusion that there's something there. And it's quite obvious that many, many Americans and people around the world feel that the existing system has not done well for them, that is not there to serve their interests. They're looking for various forms of lottery tickets. They know that the lottery doesn't actually work in their favor, but maybe if there's a magical lottery that only they can figure out, that old people can't figure out how to gain access to this lottery, maybe it is actually the secret to gaining wealth, right? And unfortunately, that's what we're seeing. We just see a lot of fraud and a lot of really bad behavior around these tokens, where everything is focused on how do we create a trading environment as compared to creating something that has genuine utility.
And, I wanted to ask you this, but let's just take the top two out, Ethereum and Bitcoin, and say down the lane, say from Dogecoin on down, market cap. If I gave you, Mike, 100 of those, just gave you the whole thing, okay, what could you do with it?
Well, I mean, so here's the great part, right? So you give it all to me, right? And then you say to me, you know what? I'll give you $1,000 for one of them. right? So $1,000 in total has been spent. But now we both get to say, wow, look at this. It's got 1,000 times 1,000 in market. It's $1 million market cap. We just made $1 million. This is fantastic, right? I'm worth $1 million. I can go to the bank if the bank will consider that as collateral and say, hey, guess what? I'll collateralize a $600,000 loan with $1 million worth of, Mike and Ted coin, right? Not quite as much fun as Bill and Ted coin, but, Mike and Ted coin I'll have to do in this scenario, right? We've created money. Now, we haven't actually, but if the bank is willing to believe, we will. And in a low interest rate environment where the Federal Reserve is basically underwriting everything, the incentive is really high to say, well, I don't really know, but maybe that is money, right? Maybe I can actually do something with that.
And I think that's what happened, really, to a high degree. And it's really interesting how it's all set up right now. And there's obviously a big narrative about it, and an ideology about it, I think.
Well, the ideology I would largely put into the narrative of, it's going to come out sounding too extreme, but it's basically a form of nihilism and anarchy, right? Which is this dynamic that you keep hearing, which is, well, sure, it's all made up, but so is the U.S. dollar, right? Okay, I'm sorry, that's just not true. You have entities that can create U.S. dollars out of thin air. The Federal Reserve is obviously one of them, as are banks, et cetera. But they have skin in the game in terms of reputations and everything else that puts some limitations around that, right? Now, not as much as we probably want, and a lot of us are very frustrated at our individual inability to access those capabilities and the perceived unfairness of who gets selected for bailouts under those conditions. But it's not actually the same, right? It really is not the same. The rules-based system is quite a bit more robust and larger than it is in crypto or anywhere else. It's also very frustrating because I'll be very candid with you, and I show people this all the time. So I actually was just cleaning off my desk, which is a never-ending process. But this is a dividend check that I received, a physical paper dividend check, because my mother, as a present for my children at some point, bought shares in Nintendo for my youngest son to have framed on his wall. Right now, the downside to that is that means that I become the holder of record. And this check is made out for $1.11. I've got another one here for my daughter for Southwest Airlines that is for 14 cents. Right now, the cost of printing a check is somewhere in the neighborhood of $1. So these are complete wastes and totally counterproductive. And in situations like that, there is genuine value in the idea of natively digital tokens, replacing stock certificates with tokenized securities that are digital in their construction, allow us to do all sorts of interesting stuff. So we see that, but that little kernel of fundamental truth has to exist at the center of every fraud.
Leads to my last question for you, which really sort of ties into this a little bit, in that if you look, I'm going to talk about the attitudes of people in the last 10 years and how get rich quick, greed at any point, make all the money you can. It really doesn't make any difference what it is. Let's just show everybody that we have a lot of money, and it's all about what it looks like and not what it is. And do you see us headed that way, or what are your thoughts on just the cultural side of that?
Well, I think that cultural outgrowth, unfortunately, is a byproduct of the loss of many of the institutions that we rely on or that we historically have relied on. But I just want to emphasize that I think it's really important for people to have ceremonial obligations to their community, in which they put on nice clothes and they show up as part of a community and they break common bread and they share a drink together and they talk about what's going on in their lives, to establish those connections so that people can look past that very thin veneer that exists when we're on social media, right? It's super easy, and we see all of this as people presenting themselves almost like television actors, right? Where it's all on a stage. As social species, as primates, we're wired to look at what other people have and to covet that, right? It's just we're mechanically wired to want that. And as that becomes more and more surface level as compared to the deep sort of connection that you would have in the robust institutions of community that existed even 30 years ago, where people went to the same schools, watched the same television programs, participated in the same local events. The news for them was on all at the same time. So you could call up your friend and say, hey, did you just see that on the news? As compared to them having basically a fantastic VCR that allowed them to time shift any delivery of any information they ever wanted to, right? The loss of that, we have not figured out how to connect in a real way yet again. And so I absolutely think that this is all a feedback loop that is being created. But at its core, I'd put much more of it on the loss of the institutions and the natural development that emerges as people try desperately to replace that.
Well, it's been it's interesting. It's certainly something that's changed changed the world the last 10 to 12 years, the way things go. And I think young people have, for a certain degree, they don't have the basis for what they might need the next 10 to 20 years. Hopefully, they'll find that as we work through. But listen, Mike, I want to thank you for being with us today. You're just a wealth of knowledge for everybody out there. And during this interview, you've seen where to go find and watch Mike. They have a great YouTube channel. The website's great. There's a lot of things you can find at Simplify. And Mike, I want to thank you for being with us.
Oh, Ted, it was a real pleasure. It was great to see you again.
All right. Thanks a lot. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.